So just looking at how monetary policy can impact the aggregate demand of the economy, the Federal Reserve can adjust the money supply. Remember, they control the money supply through buying and selling bonds. And if they want to, they can get banks to lend to each other at a lower interest rate, which is a lower federal funds rate. So they use open market operations to change the federal funds rate, and that's the rate at which banks lend to each other. So it's really the rate at which banks, or interest rate that banks pay to get their money. So if a bank can get its money at a lower rate, it can then lend it out to other people in the economy at a low rate. So for example, if the federal funds rate is low, that means the banks get their money at a low rate. Then they can have low mortgage rates, low car loans, and the idea is that all that would increase the overall aggregate demand of the economy, and vice versa. So the central bank, the Federal Reserve, can really affect the economy by targeting either a higher or lower federal funds rate. And here's the basic diagram of how this would operate. I'm not going to go through the slope of the money demand curve. If you want, email me and I'll go through it with you if you want. Take it as given though. Money supply is determined by the Fed. And let's say the Fed makes it so there's less money in the economy. So think about it. Money becomes rarer. The price to get it then is going to be higher. The interest rate will rise. So if money is scarcer, there's less money, then banks are going to lend to each other at a higher federal funds rate. Interest rates will rise in the economy. Higher interest rates make it more expensive to get a car or to get a mortgage loan, and the aggregate demand would decrease. So you can see this would be a monetary policy that would reduce the aggregate demand of the economy. Reducing money supply means higher interest rates and less aggregate demand. So during a recession, you would end up doing the opposite. You would try to shift money supply to the right. More money in the economy, banks lend to each other at a lower interest rate. That is then passed along to consumers in the form of a lower mortgage rate or lower any kind of interest rate in the economy, and then the aggregate demand would increase and hopefully make the recession not as severe or get you out of the recession by increasing the. One other thing we should bring up is this idea of a liquidity trap. A liquidity trap, I think money is the most liquid asset, so it's basically saying that you can have a scenario where the federal funds rate can be targeted to zero, which means banks can basically get their money for no interest, or basically get it for free, and the money isn't loaned out. Maybe people are just still too afraid to try to buy goods and services even at really low interest rates, or banks are unsure of the future, businesses are unsure of the future. So you'll see that sometimes. We saw that in 2008 into 2009. We saw a really low federal funds rate. Banks were able to get really cheap money, but part of the criticism of that was, well, there still wasn't demand in the economy for it, even though the rates are really low. So if you have, the money still stuck in the bank, then it's really not going to stimulate the economy too much. So then we'll look at other things that you can do. Mainly, maybe you want to bring in fiscal policy, changing the government spending, or taxes to try to stimulate the economy if you're kind of in a liquidity trap.